Why does Warren Buffett avoid dividends in Berkshire Hathaway's strategy? Warren Buffett is one of the world's most successful investors and has made tremendous returns through his investment firm, Berkshire Hathaway. Despite his success, many people are perplexed by Buffett's strategy of not paying dividends to shareholders. While there are some benefits to paying dividends, Buffett believes that there are more advantages to reinvesting earnings and avoiding the payment of a dividend. In this video, we will explore why Warren Buffett avoids paying dividends in his strategy for Berkshire Hathaway. Understanding dividends and Berkshire Hathaway's approach. Before diving into why Berkshire Hathaway doesn't pay dividends, it's important to understand what dividends are and how they work. Dividends are payments made by a company to its shareholders from its profits. They are typically distributed quarterly or annually, and the amount paid out is determined by the company's board of directors. Companies can choose to pay out all, some, or none of their profits as dividends. In the case of Berkshire Hathaway, the company has never paid a dividend. Instead, it has chosen to reinvest its profits back into the business or acquire other companies. This approach has been consistent throughout the company's history, and it's one of the key components of Warren Buffett's philosophy. So, why does Berkshire Hathaway avoid dividends? The answer lies in the company's focus on long-term value creation. Buffett believes that reinvesting profits back into the business or acquiring new companies will ultimately lead to higher returns for shareholders. In addition to this, Buffett is known for his dislike of unnecessary taxes. By not paying dividends, the company can avoid passing on taxable income to its shareholders. It's important to note that just because a company doesn't pay dividends doesn't mean it's not profitable or financially stable. Berkshire Hathaway is a prime example of this. The company's financial strength and flexibility allow it to allocate capital in ways that maximize long-term value for shareholders. Overall, while dividends can provide short-term benefits for shareholders, Berkshire Hathaway's approach focuses on long-term value creation and financial strength. The Buffett philosophy on dividends. Warren Buffett is known for his value investing strategy, which involves investing in undervalued companies and holding on to them for the long term. One aspect of this strategy is his aversion to dividends. Berkshire Hathaway, his investment company, does not pay dividends to shareholders, even though it generates significant profits each year. Buffett has explained his philosophy on dividends in various interviews and shareholder letters over the years. He believes that dividends can be a signal that a company is unable to reinvest its profits effectively. If a company is generating excess cash but cannot find profitable investments to make, it may resort to paying dividends as a way to appease shareholders. Buffett also sees dividends as a way to attract short-term investors who are only interested in earning a return on their investment as quickly as possible. These investors may not be willing to hold onto a stock for the long term, which can cause volatility in the stock price. By not paying dividends, Berkshire Hathaway attracts long-term investors who are interested in the company's fundamentals and growth potential. Furthermore, Buffett believes that by not paying dividends, a company can reinvest its profits back into the business. This can lead to greater growth and ultimately higher stock prices. Berkshire Hathaway has a history of investing in companies that have strong growth potential and long-term competitive advantages. By retaining earnings, the company can invest in these companies and generate greater returns over time. Overall, Buffett's philosophy on dividends is focused on creating long-term value for shareholders. He believes that by reinvesting earnings back into the business, a company can achieve greater growth and generate higher returns for shareholders in the long run. While dividends may be attractive to some investors, Berkshire Hathaway's approach prioritizes long-term value creation over short-term gains. Benefits of dividends versus Berkshire's focus on long-term value. Dividends have long been considered a hallmark of a healthy and successful company. After all, a consistent stream of dividend payments can provide investors with a reliable source of income and a clear indication that the company is doing well financially. However, while many companies prioritize dividends, Berkshire Hathaway has taken a different approach. Warren Buffett's philosophy has always been focused on the long-term value of a company rather than short-term gains. As such, he has always been wary of dividends, which he views as a form of distribution rather than an investment. Instead of paying dividends, Buffett prefers to reinvest the profits back into the business to drive growth and increase the overall value of the company. There are several benefits of dividends, of course. Companies that pay dividends can often attract more investors, particularly those looking for steady returns and a low-risk investment. Dividends can also signal financial stability and a commitment to shareholder value. Additionally, investors who receive dividends can use that money to reinvest elsewhere or use it as a source of passive income. However, Buffett has always maintained that focusing on long-term value is more important than short-term gains. By reinvesting profits, Berkshire Hathaway has been able to grow its portfolio of businesses and increase its overall value over time. This focus on long-term value has been a hallmark of the company's strategy for decades, and it has served them well. Another key component of Berkshire Hathaway's strategy is capital allocation and share repurchasing. Rather than pay dividends, the company has chosen to repurchase its own shares when they are undervalued, thereby increasing the value of each remaining share. This strategy not only rewards existing shareholders, but also ensures that the company retains more of its profits for future growth and investment. Ultimately, Berkshire Hathaway's decision not to pay dividends has allowed the company to maintain its financial strength and flexibility, giving it the ability to weather economic downturns and invest in new opportunities as they arise. While dividends can be beneficial in certain circumstances, it is clear that Buffett's long-term focus and commitment to reinvesting profits have helped the company achieve success over the years. Capital allocation and repurchasing shares. Another reason why Berkshire Hathaway avoids paying dividends is because the company prioritizes capital allocation and share repurchases. As a long-term investor, Warren Buffett believes that retaining profits within the company and investing in new projects is a better way to grow the company's value in the long run. Berkshire Hathaway has always focused on acquiring undervalued businesses and investments and allowing them to grow within the company. As a result, the company's shareholders have seen significant returns on their investment over the years. Additionally, when Berkshire Hathaway repurchases its own shares, it increases the value of its remaining shares by reducing the total number of shares in the market. Warren Buffett has also emphasized that he prefers share repurchases to dividends as a means of returning capital to shareholders. Repurchasing shares can be more tax efficient for investors and provide them with more control over when and how they sell their shares. In contrast, dividends are typically taxable income and cannot be deferred or avoided by shareholders. By repurchasing shares, Berkshire Hathaway can also allocate capital more efficiently, investing in projects that will provide higher returns in the long term. The company's ability to allocate capital and make sound investment decisions has been one of the key factors behind its long-term success. Financial strength and flexibility without dividends. Despite Berkshire Hathaway's lack of dividends, the company has been able to maintain financial strength and flexibility. This is largely due to its successful investments and diversified portfolio. Instead of distributing profits through dividends, Berkshire Hathaway reinvests profits back into the business and continues to look for new investment opportunities. One of the main benefits of avoiding dividends is the flexibility it provides. By not committing to a regular dividend payment, Berkshire Hathaway can adjust its capital allocation strategy to respond to changing market conditions. This means that the company can choose to invest more in growth opportunities, pay down debt, or repurchase shares if it deems it appropriate. In addition, Berkshire Hathaway has a solid financial foundation with high cash reserves, which provides a cushion in times of economic downturns or market volatility. This allows the company to make strategic investments in acquisitions when other companies are struggling to maintain their financial stability. Moreover, Berkshire Hathaway's avoidance of dividends has not affected its ability to attract investors. The company's track record of successful investments and long-term growth strategy has made it a highly sought-after stock, even though it does not offer a dividend payment. Risks associated with dividends and alternatives. While dividends may be a popular strategy for many companies to reward their shareholders, there are also risks associated with them. Firstly, dividends are not guaranteed. Companies can decide to cut or eliminate their dividends at any time, which can lead to disappointment and frustration for shareholders who rely on them for income. Secondly, focusing too heavily on dividends can hinder a company's ability to reinvest profits back into the business. This can limit growth opportunities and reduce long-term value for shareholders. On the other hand, Berkshire Hathaway's approach of prioritizing long-term value and capital allocation allows for flexibility and agility in the face of market volatility and economic downturns. By focusing on repurchasing shares and investing in businesses with strong growth potential, Berkshire Hathaway can continue to create value for its shareholders without relying on dividends as the primary means of return. Overall, while dividends may offer short-term benefits, Berkshire Hathaway's focus on long-term value and flexibility without dividends can lead to more sustainable and impactful returns for shareholders over time. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.